Assalamu alaikum, inshallah you're well guys. So today I'm going to speak about something different which can impact us regardless of whether you work in finance or not, and that is capital gains tax. Now in the 21-22 tax year, HMRC collected a record £16.7 billion in capital gains tax, and almost 400,000 people paid the tax. So if you own assets, it's very important you have an understanding of this. Firstly, what is capital gains tax? Simply put, it's a tax on the gain that you make when you dispose of an asset and it has increased in value. So as an example, let's say you buy a Rolex watch for £10,000. In a couple of years, you sell that watch for £20,000. You've made a gain of £10,000 in that deal, which may be subject to capital gains tax. There are some exemptions to be aware of. So firstly, if you sell your personal car or your personal house, which you've lived in all your life, those assets won't be subject to any capital gains tax. And you also have things such as a stocks and shares ISA, where any gains you make on the amounts invested in that ISA are again exempt from capital gains tax. You also have an allowance similar to the personal allowance for income tax. So if your gains are below this allowance each tax year, there's no tax to pay. Otherwise, you would pay tax on the difference between the actual gain and the threshold each tax year. And final point I want to make you aware of is that capital gains tax is only on individuals. So if you own assets through a limited company, you don't pay capital gains tax. You would instead pay corporation tax. In terms of the tax you pay, this depends on your total taxable income. So if your earnings are in the basic rate threshold, which goes up to £50,270, then you would pay tax at the rate of 10% or 18% if you've sold residential property. But if your earnings go above the basic rate threshold, then you would pay tax at 20% or 28% if you disposed of residential property. So as an example, let's say you work a job and you have an annual salary of £25,000, and aside from that, you also invest in paintings. You sell a few, and in the same tax year, you make a total gain of £20,000. Now combined, your total taxable income is £45,000, which is within the basic rate threshold. Remember, it goes up to £50,270. So you would pay capital gains tax at a rate of 10%. And that works out to be £1,400 because remember guys, you have a tax allowance each year. So you made gains of £20,000, you deduct your tax allowance, which is £6,000 for this financial year, and you're left with total taxable gains of £14,000, which at 10%, because you haven't sold any residential property, works out to £1,400. But if that was residential property, then like I said, you would pay tax at a rate of 18%, which on the £14,000 taxable gain works out to be £2,520. In another example, let's say you have a base salary of £60,000 and you make capital gains of £20,000. Because your earnings are now over the basic rate threshold, you would now pay tax at 20% or 28%. So if it's at 20%, it would work out to £2,800 because again, remember guys, you deduct your £6,000 allowance. Now, there is a lot more detail behind capital gains tax, such as what counts as a disposal, deducting costs when you purchase the asset, and also what happens when you gift an asset and you don't receive any money for it. But for the purposes of this video, I just wanted to provide a basic overview. Now, why does this all matter? Well, it's important to have knowledge because a lot of people are trying to build wealth, and a common way of doing that is by purchasing assets and selling them for a profit later on. So inshallah, in the future, you may come into scope for capital gains tax. One of these methods I'm going to talk about is by purchasing shares. People like investing in the stock market, and yes, they are assets, so they are in the scope for capital gains. The good news is that you can invest in a stocks and shares ISA, which stands for individual savings account, and not pay any tax on the profits that you make. This financial year, you can invest up to £20,000. So let's say you open a stocks and shares ISA, you put £20,000 in, and in a few years, you sell those shares for, let's say, £250,000. You've made a gain of £230,000, but because you invested in a stocks and shares ISA, there's no capital gains tax to pay. As with everything, there are a few things to be aware of. So that £20,000 limit is split across all 4 types of ISAs. So you have the stocks and shares ISA, you also have a cash ISA, you have a innovative finance ISA, and you also have a lifetime ISA, which is popular amongst those of you who are looking to buy your first home. So if you put £4,000 into a lifetime ISA, let's just say, that leaves you with £16,000 that you can invest across the remaining 3 ISAs. On a side note, guys, when you do open an account with a trading provider, such as Hargreaves Lansdown or Trading 212, make sure you open up the right type of account you have to open a stocks and shares ISA, not a normal investing account. If you make a mistake and you open a normal investing account, the gains that you make will be subject to capital gains tax. Second thing I'm going to briefly cover is cryptocurrency, which again, in the eyes of HMRC, is an asset, or it can even be deemed as income if you trade regularly enough. Say you're a daily crypto trader, but for many people who have a job and they've invested in crypto on the side, hoping it will go up in the future, HMRC will view this as an asset, so it's in the scope for capital gains tax. And be aware, guys, that many crypto trading platforms such as Coinbase do share data with HMRC. So in the future, depending on your trading activity, you may receive a letter from HMRC asking you to complete a capital gains tax form. But again, guys, remember, you're only liable for capital gains tax when you dispose of an asset, which for many people means selling the asset. So if you're currently holding Bitcoin, let's just say the value has shot up, because you haven't disposed of that asset, you're still holding on to it. There's no capital gains tax to pay. This is why the timing of when you buy and sell assets is very important when it comes to tax planning. The final area I'm going to speak about is flipping property. So you must have seen the ads on social media. You buy a rundown house for 20k, you spend 30k on it fixing it up, and then you sell it for 200k. Buying and selling property, again, is in scope for capital gains tax. The only real exemption to this is if you're selling your main house that you've lived in, let's just say all your life, and you're claiming what's known as private residence relief. Now, what some people may think is, I've got no property in my name, let me go purchase a rundown house, spend some money fixing it up, make a tidy profit, and I'll tell HMRC that I lived in that property during the period which I owned it, it was my main home, and I'm going to claim private residence relief, so there's no capital gains tax to pay. But it doesn't work like that. HMRC aren't dumb. They're likely to follow the evidence trail, which will show otherwise. So as an example, they may look at property listings, and they may find the original ad where the house was for sale, and let's just say the house was really run down and it didn't have any electrics. How are you going to show that you lived in the house when it had no electrics? Secondly, they may look at your bills. So if you haven't paid any money towards gas, electric, water, your utilities, how are you going to show that you were living in the house? But a big telltale sign often is council tax. Now, normally what happens is when a house is uninhabitable, say it's going through a lot of building work, you have no council tax to pay. So again, if you haven't paid any council tax, say during the period of ownership, it's very difficult to argue that you were living in the property at the time. In those instances, it will become apparent to HMRC that this property was bought as an investment, not as a residential property to live in. Previously, there was a stereotype that capital gains tax was only for the wealthy. But as it should be quite clear in this video, it applies to many people, so it's important to have knowledge on these matters. Inshallah, I'll leave it there, guys. As always, any questions or queries, please feel free to comment below or message me on Instagram.